All right, so today I wanted to make a quick video on a company that I've talked a little bit about before, but I wanted to talk about it more. This is Accenture, ticker symbol ACN. Again, they provide, consulting, outsourcing, stuff like that, and that is actually a very underrated business, right? I was listening to Patrick Bet-David video recently. He's talking about how underrated of a business model that consulting and stuff like that is, and this is one of the top. It might even be the top company out there for that. Now, again, obviously, my opinion, whoever's opinion, do your own due diligence as usual. But again, this is a company that's always performed very, very well, right? Very, very well. So let's get into it here, and I'll talk a little bit more. So again, if we look at their numbers here, again, financial health current ratio 1.3. That's decent. Shares are going down. That's good. Growth is not the greatest, but again, this is in a weakening economy, and again, that's an area to where things aren't going to do as good, right? Management is decent. Profitability, they're decent. If we look at their valuation, though, again, they are a little bit below their historical valuation. So again, if you're looking to pick it up, now is a good time. If we get a recession, I think that again, if this company goes down more, it is near its 52-week high, though. So again, ideally, you probably would get it below $300, but that might not happen, right? If we look at its dividend, this is another thing that I really like here. Again, 1.65% payout ratio on free cash flow is 36%. They're going that 13% per year. So again, you're going to get a very, very nice dividend growth over time in this company. I mean, if you go back 10 years, you have almost a 7% yield on cost, right? So you have a company that has a lot of growth potential, but also is going to grow that dividend very nice. That's exactly what I like to see. If we look at its balance sheet, pretty strong balance sheet. Total assets, 66.7%. So again, that's looking good there. If we look at the metrics here, let's look at the profitability ratios. Always has had strong, consistent profitability, right? That's one of the main things that I look for and I want in a business is consistent profitability, because if the profitability is all over the place, then you got no idea, unless you're willing to do crazy amounts of research. It's very hard to invest in a business like that without getting burned. But you look at a company like this, the operating cash flow margin has been between 13.75% and 18.5% going back to 2017, right? So for the last 7 years. So again, very, very consistent there, which is exactly what I want to see, right? That's exactly what I want to see. If we look at the return on invested capital here, 46% is crazy good, right? That's an insanely good number. That's another thing that I really like about this company. Again, very, very good at deploying capital, right? That's what I want to see. Let's get back into the financials here and look at the cash flow. Again, this is a company that has consistently grown cash flows over time, right? Again, look at the number here. Again, consistently growing over time. That's exactly what I want to see. If we get into the valuations here, this is the last thing I'll bring up. Again, another thing that you're going to see is, again, consistent growth over time. Going back 10 years, they've grown free cash flow 12% per year, which is pretty solid, right? That's pretty solid. And not only that, the growth rate to their valuation has been 4%, right? So that's another thing that I bring up all the time that is very important too, is that you want to keep an eye on how fast the valuation for a company is growing, because if it's growing as fast as the actual growth rate, then basically what it means is that the increase in share price as far as the company goes, it's driven entirely by people simply paying more for the same amount of earnings, which is not what you want, right? That's not what you want. You want companies that are growing their cash flows significantly more than the valuations, right? That's what you want. And again, 12%, it could be better, but again, that's still solid growth. If we look at its valuation here, so again, where should you be picking it up? The average price to free cash flow is just under 25. It's currently at 27.7. So like I said, ideally you would get it a little bit cheaper, but I'm still dollar cost averaging. This is a company I probably will dollar cost average for the next decade or two. barring anything crazy happening. In my opinion, this is one of those companies that you just buy it, set it, and forget it. Like I think Waste Management's an example of that. There's a handful of them, right? That are companies. Again, this company is going to be cyclical. Waste Management is not cyclical, but because, I mean, when times are good, companies are going to spend more on consulting and outsourcing, stuff like that. When times are good or bad, they're going to cut back on that. But again, a lot of times the way that you grow your company is through outsourcing and consulting, right? Like I mentioned earlier, consulting is a very, very underrated business. I mean, there's not a lot of people that talk about how important that is to growing your business, right? So again, all in all, I think it's a good company, and I think it's a company that everybody should own. Obviously, like I said, in my opinion, do your own research, but I think this is one of those companies that I think everybody should own. So anyway, that's what I wanted to talk about today. If you liked the video, hit that like and subscribe, and stay tuned for more.